Hello people, I am Yash Kavya. I manage and look after tax Q&A here at Quicko, which is essentially a platform which allows you to ask all your tax related questions. And these days when I'm spending time on tax Q&A, one certain trend that I've seen is that a lot of people have a lot of questions regarding tax loss harvesting. So Vishwajit and I decided to have a little conversation about what is tax loss harvesting exactly. So yeah, Vishwajit, what is tax loss harvesting?
So thanks again, Yash. Thanks for setting this up. I think before we start tax loss harvesting, just setting up a little bit of context. January, February, March are usually the busiest month when it comes to taxpayers investing into tax saving instruments. The most popular one, of course, ELSS. There is tremendous interest in ELSS funds, and there is a lot of fund inflow during these 3 months that we see. Also from our friends at Ditto, we are hearing that also a lot of life insurance and health insurances are purchased during this 3 months. One such other topic, of course, is tax loss harvesting. There is tremendous amount of interest. Nitin also talked about it last week. So we thought, why don't we dive deep into the topic and probably untangle it for everyone. So I think before we start talking about tax loss harvesting, let's talk about taxability of trading investing activity, right? Although a lot of you may be aware of it, but let's quickly recap it. Any equity shares, MF ETFs are covered under securities capital gains. If you hold them for more than 365 days, it's considered long term. Less than 365 days, short term. Long term is taxed at 10%. There is a 1 lakh base exemption under 112A, and short term is taxed at 15%. Similarly, if any debt instruments, right, bonds, debentures, also mutual funds and ETFs which have debt asset allocation, for them greater than 3 years is considered long term, less than 3 years is considered short term. Long term is taxed at 20%, and short term is taxed at slab rate. We'll keep intraday and F&O mostly out of this discussion because tax loss harvesting primarily focuses on harvesting your harvesting your capital losses. But however, for clarity, intraday and F&O both are covered under business profession income, and hence they are taxed at slab rate. So without further ado, let's talk about tax loss harvesting. I think all of you are familiar with console. You go to console to access your holdings, your portfolio related reports. You also access your P&L reports from console. If you've been to console, one thing you will realize is you have your realized profit and losses. That means positions that you have already liquidated and P&L related to that, and you may also have come across unrealized or notional profit and losses, right? So what are notional profit and losses? These are the positions that you are still holding, but depending on market value, console calculates your notional profits and losses. So I think it's a nice bridge to understanding what tax loss harvesting is. It essentially is a practice of realizing losses by selling your loss-making shares and mutual funds before the end of financial year. Now, a common question is, why would you want to sell something, right? If you are long-term investor, if you're committed to a position, why would you sell it? The thought process or the idea is, by selling those positions, you realize those losses and you can set them off against any realized gains for that financial year, right? What does that do? That helps you reduce your taxable capital gains income. Now, remember in the previous slides, we talked about capital gains are special rate incomes. They're taxed at 10% or 20% if long term, and 15% in slab rate if it's short term. So by reducing your capital gains income, you are reducing your tax liability, right? So it's a very good way of saving your taxes. Now we often get asked whether this is legal or not, right? So, and mostly this question comes from US stock markets, because IRS, which is the regulatory body there, has rules against what's known as a wash sale, right? What is wash sale? You sell a security and you buy it again. Wash sale rule also covers if you buy first and sell later, right? So they essentially prescribe a 30-day window within which you cannot reacquire the same position, and if you do, then you cannot take advantage of tax deductions similar to tax loss harvesting. However, it's not explicitly defined in Indian tax code, and hence it's an acceptable practice right now. The other important thing is you have to do tax loss harvesting across your portfolio and not just one demat account, right? So when you are doing tax loss harvesting, you will have to consider your realized profits and losses across your entire portfolio, and similarly your notional profits and losses across your entire portfolio. Now, what are the rules around setting off losses, right? Because the whole concept is around setting off, first realizing your losses and then setting them off against gains. So again, a quick recap. So any long-term losses can be set off against long-term capital gains, and they can be carried forward for 8 years if you are not able to set them off. Any short-term losses can be set off against both short-term and long-term gains. Now the common question is, why is that, right? Because long-term capital gains are taxed at a lower rate, they cannot be set off against short-term gains which are taxed at a higher rate. However, short-term losses can be set off against both short-term and long-term gains. Again, they can be carried forward for 8 years. Now, intraday and derivatives, right? We talked about them. They are taxed as business profession income at slab rate. You can set off intraday only against other intraday gains. However, when it comes to derivative, you can set them off against any income except salary. Now, why can't you set them off against salary? Because salary and business profession are two sides of the coin, right? So, what Income Tax Act prescribes is if you are incurring losses from business, you cannot set them off against salary. Again, carry forward rules are 8 years for non-speculative business income arising out of derivatives trading, and 4 years you can carry forward in case of intraday. I think the best way to kind of understand it would be to go walk through an example, and there is a very nice example here. But I think let's do it through a simulator. Folks at Quicko have designed a very good kind of Figma simulator. This is not a real product, but it's a simulator that helps us practice tax loss harvesting. Of course, it's for a very simple scenario, but then you can go and scale it to your portfolio. So let me open the simulator first. Great. So as you can see here, my pre-harvesting, right, income situation, and this part communicates a post-harvesting income situation. So this is already realized gains, and this is where, as we do tax loss harvesting, we'll see the impact of it on the taxability, right? So what am I seeing here? My short-term capital gains are 50,000 rupees. My long-term capital gains are 1,80,000 rupees. I haven't done any tax loss harvesting so far, and which is why post-harvesting capital gains are also same. Now let's say these are my holdings, right? So these are the scripts that I hold in my portfolio right now. I hold Bharti Airtel, IndusInd Bank, and Yes Bank. Primarily stock loss, tax loss harvesting is, like I said, done at a portfolio level and not demat account. Also, you have to understand FIFO settlement before you understand tax loss harvesting, right? So in India, taxes on capital gains or investing is calculated in FIFO settlement manner. That means you have to set off in first in, first out manner, right? So let's say we expand into Bharti Airtel, and this is my current holding. I have a few positions that are long term, and I also have a short term position. Because of the FIFO rule, you will have to first sell your oldest position, the first position that you acquired. In this case, 12/12/2018 is the oldest position. So I can sell it, right? So when I sell it, you could immediately see, because this is a profit making position. What I did is I harvested 8,000 rupees in losses. As you can see here, it's reflected here. My LTCG have gone up by 8,000. Hence, it's instead of 1,80,000, it's now 188,000 rupees, right? You also see this frowny face here that indicates the sentiment, right? You wanted to do tax loss harvesting, but you ended up doing gain harvesting. Now because now we have sold this first position, we are also eligible to sell this second position in FIFO manner. So when I sell this position, as you can see now, now what I've done is I've harvested some long-term losses, right? So my long-term losses from this position is 60,000 rupees, and my long-term gains from my first position was 8,000 rupees. So effective long-term losses that I've harvested is 52,000 rupees. As you can see in the chart up here, now it's acknowledging the long-term capital losses of 52,000 rupees. Hence, my long-term gains have reduced from 1,80,000 to 1,28,000 rupees now. Now let's see what happens if I sell my short-term position. So when I sell my short-term position, I am again harvesting about 60,000 rupees worth of losses. You can see it in the chart up here. The lighter red is short-term losses. The darker red is long-term losses. What's interesting here is my short-term gains, which was 50,000 rupees, have now come down to zero, right? Because I've harvested 60,000 rupees worth of short-term losses. But what's also happening is, remember in the loss treatment slide, we talk about that short-term losses can be set off against both long-term and short-term gains. So the remaining 10,000 rupees from my 60,000 losses, I'm able to set it off against long-term gains as well. So my long-term gains have now reduced from 1,28,000 rupees to 1,18,000 rupees. Now let's go back to the slide and see what's the impact on taxability, right? You can, like I said, you can in a FIFO manner do the tax loss harvesting on any of the scripts that you that you have in your holdings. In this case, we just went through the first script. You could also do it across multiple scripts. So let's look at the impact on taxability. So as you can see, my tax payable pre-harvesting were 7,500 rupees on my short-term gains, which is 15%, taxed at 15%. And on 1,80,000 long-term gains, I was liable to pay 8,000 rupees because 1 lakh is tax exempt under section 112A. On remaining 80,000 at 10%, I am liable to pay 8,000. So my total tax liability was 15,000 rupees 500. Right now, as we saw in the simulator, after I do tax loss harvesting, now my realized profits are, as you remember, the short-term capital gains were reduced to zero after setting off losses, and my long-term capital gains came down from 1,80,000 to 118,000, and hence my post harvesting tax liability, essentially my short-term tax liability goes away because I don't have any taxable short-term gains, and my long-term liability is now reduced to 1,800 rupees. So folks, here 15,500 rupees versus 1,800 rupees, I ended up saving almost 13,000 rupees. So that's essentially what tax loss harvesting is in a nutshell.
Cool. Thanks for taking this up, Vishwajit. But there were certain other questions that have come through the platform Tax Q&A, and one of them was, so all right, we understand what tax loss harvesting is, but what is tax gain harvesting?
Cool. So tax gain harvesting, remember I told you that long-term capital gains where STT is paid is exempt up to 1 lakh rupees under section 112A. So there's this debate that what you could do is you can sell up to 1 lakh rupees worth of your long-term capital gains, reacquire those positions, hence harvesting those gains which are tax exempt. So it's a good way to save taxes off of your long-term capital gains.
Got it. And when can we repurchase the shares that are sold for tax loss harvesting purposes?
Ideally, you should wait for at least 1 day because if you sell and reacquire those positions on the same day, they can be considered intraday. And if they are considered intraday, then you cannot take advantage of tax loss harvesting. We often get asked, can it be reacquired through a different demat account on the same day? The answer still remains the same. If it's purchased on the same day, it can potentially be considered intraday. So we recommend our customers usually to do it in T+1 manner.
All right, got it. And so what is the last date to harvest these losses?
Usually the last trading day of the financial year is the last opportunity to harvest your losses. Fortunately this year 31st March happens to be the last day of financial year, and it's also a trading day, so you can up to 31st March you can execute your tax loss harvesting. There's also common misconception that you have to acquire or reacquire the positions within the same financial year, which is not true. I mean, you can reacquire positions in the next financial year as well.
There's one question that came through quite poignantly, which was, can a trader choose to harvest short-term capital losses or long-term capital losses for the same script?
Absolutely. I mean, like we saw in the example in the simulator with the Bharti Airtel instance, right? I was able to harvest the losses from the same script, and if I happen to have realized gains from the same script, I can of course set them off against each other. So there is no rule around script. However, the only rule is you have to do it in free-form manner, script-wise, right? So you will have to liquidate the oldest positions first.
Is the income from capital gains exempt under the basic exemption?
Again, this is again a very frequently asked question, and the simple answer to it is absolutely. It's exempt under, it's eligible under basic exemption. However, if you have any other slab rate incomes, right, like your salary or business profession income, they get the precedence. That means your basic exemption would be applied against slab rate incomes first, and then against special rate income. But let's say if you don't have any slab rate incomes, then of course your capital gains income will get the benefits of basic exemption up to 2.5 lakh rupees.
And lastly, again, one such question from a lot of Zerodha users was that when can you actually execute tax loss harvesting for stocks that they hold in their Zerodha demat accounts through Quicko?
Great question again, right? You've always known that Team Quicko and Team Zerodha always works together on bringing out latest and greatest features. This is also something that we have started working on. However, you have to understand it's not as easy as it sounds. Like I said, tax loss harvesting has to be done across portfolio. So it's not just matter of Zerodha and Quicko partnering, but it's all entire capital market ecosystem, most of the brokers partnering with us. But what we would do, like everything else, is we would roll out an MVP with in partnership with Zerodha, and anybody who only is trading through Zerodha demat account would be able to take advantage of it. And slowly and gradually we'll add support for other brokers as well. So this is something in our pipeline on our roadmap, and you will see it very soon.
So thanks for taking this up, Vishwajit, and I'm sure this will clear a lot of air that surrounds tax loss harvesting.
Thanks again, Yash. I think we need to do this frequently. We have a lot of questions coming on to text Q&A, and I think a lot of it we can share back with the community. Thanks.
Looking forward to many more chats on many more different topics. And if you have any questions meanwhile, you can always shoot them on qa.tax and we'd love to answer.